Okay, everyone, welcome back. And we were discussing previously pivot points and talking about cheat areas, low cheats, entry points. Now, what we're going to cover here is what you do or what you look for after you buy. So, we're going to discuss natural reactions, tennis ball action, confirmations and violations, and what you do and what you don't want to see after you make the trade. So, what we're looking for is the signs to tell us whether we should hold maybe for a larger move and continue holding the stock, or if things are not going so well, maybe some violations show up, and that would let us know to maybe even reduce the position or even sell the position even before it hits our stop loss, which we'll get into stops later on. But again, I always use a stop on every trade, but that doesn't mean necessarily that we don't get the signs that something's wrong with the stock. So we're going to talk about that. So first off, let's take a look at Lululemon here, and where I was buying it coming out of this nice big base here. You can see coming out of a perfect pivot. Volume comes way in. You get the 1-2, just like we talked about. I mean, this is a classic setup, perfect coming out of a VCP. And what happens is, first of all, most of the stocks that break out, or at least 50% of them, are going to pull back and maybe even to your breakout point or below your breakout point. So the question is what's natural and what's abnormal? What's a normal pullback and what's an abnormal? Now, we call these natural reactions. When we get a pullback and then it moves back into new high ground in fairly short order, we call it a natural reaction. And natural is good. Natural is okay. And each time you have a natural reaction, that's showing that the stock was able to pull back and then recover into new high ground. The key is that you want to look in the first couple of days to a week or two after you buy the stock to assess the quality of the breakout. Normally, I'm going to know in a few days if the breakout was came out fairly on schedule, and then after a week or two, I'm going to know if it got through its first pullback or so and was able to let me know that it was just a natural reaction. Now, what I look for, and you see here, it says tennis ball action. That's the bouncing back into new high ground from a natural reaction. And I just real quick wanted to give you some history and pay my respect to Bill Berger, who was someone I looked up to back in the 80s. Bill, you could see he kind of looks like Santa Claus, a real life Santa Claus. He's passed away, but I really love this guy. And I had the privilege of meeting him, and I asked him, and just to let you know, Bill Berger ran the Berger 100 fund, and they were pretty much beating the pants off of most other mutual funds. He had a small and mid cap fund. You can see right here in the back, I couldn't really find any pictures of him. I think this is the only one I could find, but you can see his 19-year track record was 16%. Here for one of his funds, I guess, and the other one was 14%. So really good numbers for a mutual fund. Those are really good numbers to put down 16% per annum for almost 20 years. And he had some really good runs. Anyway, he impressed me, and I met him, and I went up to him and I said, Bill, let me ask you, what is the key to your success? You know, how you've done so well. Well, if you were to boil it down, what's the key to your success? He said, son, I buy tennis balls and I sell eggs. And I thought that was, obviously a kind of a strange statement. I didn't really know what it meant, but it turned out to be $1 million sentence for me, or a multi-million-dollar sentence that I've made part of my thinking and my strategy ever since, once I understand what he was talking about. And basically, he said, you have tennis balls and you have eggs, and tennis balls bounce back and eggs go splat and they don't bounce back. So you're assessing the stock to see if it in fact is a tennis ball. And back to the Lululemon here, you can see we break out for a few days, pull back here, back to the breakout, and then right back into new high ground, and very convincingly a few days up rally, and then another another pullback here, and then bang, right into this is really serious tennis ball action on a big gap. I think they might have had earnings there. So this is really classic. Now, at some point, the stock gets extended. After you get a few natural reactions and you get extended, if you're a swing trader, you're going to probably be looking to sell. If you're a longer term holder, you might not. But I tend to sell after usually 2 or 3 natural reactions. But again, let me show you, we're moving to page 199, the Netflix example. So again, you can see everything that we talked about previously is all, we're building upon that, right? You can see that we have a perfect VCP setting up nicely. You get the volume comes in, you get the breakout volume, you even have some follow through volume when you get that tennis ball action. Look at that big volume coming on that, after that natural reaction. So you break out, you come in here for 5 days, and then wham, right into new high ground. Then you come in for 7 days and back into new high ground. And this is classic tennis ball action. Dave, when you first buy a stock, what are you looking for in those subsequent, few days or really a few weeks? I mean, we're going to talk about follow through buying in just a minute. But as far as, looking at the pullback, what are you looking for to see the stock is of a quality breakout when you get that first pullback?
Well, the best breakouts are the ones that go up 3, 4, 5 days in a row and just really take off. But in this example with Netflix, it had a 1 day where it broke out, which is fine. And as you highlighted, it did it on very high volume. And then the next 3 or 4 days, it pulled back on lighter volume. And that's what you usually want to see. If the stock is pulling back, you want to see it pull back on lighter volume. The worst thing that can happen is if the stock breaks out and then the volume comes in a lot heavier. Now, that's not what happened in this situation. It broke out, pulled back 3 or 4 days, then the volume picks up and you can see the huge, where you label, the tennis ball action. That's exactly what you want to see, is huge volume on the upside, lighter volume, and you see again lighter volume as it pulls back, and in relation to the volume surge on the recovery, and it doesn't pull back that far. See, this stock goes from 48 to almost 58, and then pulls back to about 53. So it gives up maybe half of its gain, but it's on lighter volume, and then it continues upward, and that's what you will see throughout the run of that stock.
Right. So it has good volume characteristics. And you're going to see that, all of these really good performing stocks are going to have very similar type footprint where you're going to see them break out, they'll pull back orderly, and then pretty quickly get back into new high ground. Like I said, I'm looking for the stock to recover usually in a week, no more than 2 weeks. If it starts getting into 3, 4 weeks, now you're building a whole new base. And sometimes that happens when the market might go into a correction after the stock breaks out and it holds the stock back and you get a base on base. But under most circumstances, you're going to know pretty quickly if the stock is acting normal or acting abnormal. And later on, we're going to go over some violations to zoom in on this action here and to really decipher whether you have a problem there or not, or if you have some confirmation. So we're going to get into that in just a minute. But right now, just looking at the pullbacks and a natural reaction to a tennis ball action is simply a stock pulling back after it breaks out and then getting back into new high ground. That's the key. And then it pulls back again, back into new high ground. And like I said, after a few of those, then you might want to start thinking about some, maybe you're up 15, 20% or more on the stock. And at that point, maybe you can start thinking about maybe selling a little bit of the stock if you're shorter term oriented. This was Great Plains, of course. You can see came out of a nice base here. Again, look at the big volume on the breakout. The volume comes in prior to the breakout. You get that first natural reaction, tennis ball action, second natural reaction, tennis ball action. You even have another little reaction right here, back into new high ground.
And the other thing I'd like to point out too is when a stock is in an uptrend, it usually has it drifts to the right. It's either drifting to the right or it drifts, or it can go sideways. You see how this drift to the right and then it starts moving up. Same thing, just drifts down a little bit, goes sideways. You don't want to see it wedging up towards, let's say, 2:30, 2 o'clock on a clock, and this is I describe it to people who've really never looked at the market. It's almost like a staircase. It goes up it goes sideways, it goes up and sideways. And as long as this staircase continues to be built, then you've got a nice uptrend.
Yeah, you're saying it builds to the right. You mean, it drifts to the right, drifts down, you're saying.
It drifts down, drifts down to the right. It doesn't drift up to the right. It's either sideways or down.
Yeah. And another thing to point out, Dave, and you might want to talk about this, when a stock breaks out and if there's institutional support, they're gonna support that stock pretty quickly because they're building a position, right? And they're trying to get in there, and they're not just buying on just one day. So this is how we tell the difference. We're trying to decipher whether you have retail buying moving the stock out or really truly institutional buying. And we're going to show you a few other things to look at in just a second, but this is one of them, because if institutions are really in there accumulating positions at that breakout, when that stock pulls back, it only has to pull back for a few days, and usually they're going to come right back in and start buying it again because it got away from them. When it gets up like this here, now they start defeating their purpose. They're not going to chase it up. This might be a big fund trying to take a position. Now it gets away a bit. They're going to back off. Now the stock comes in, and they come in and they support the stock.
Yeah, and as I've said in the past too, the more days you get up in a row, the more evidence of that being maybe just not one institution, but 3, 4, 5, all trying to fill out their position at the same time. And sometimes it takes them weeks to do that. And that's what you want to see in the volume and in the price action as the stock moves out of that base.
Right. Now here's Central Garden and Pet, which again, this is just a beautiful classic VCP. And you can see this has fractals where you've got patterns within patterns. And you've got this little VCP right in here that finishes off the handle, if you will, big cup with handle. And again, if you got to look closely, but it breaks out for a day, comes in for maybe 2 days, and then look at wham, right back into new high ground very, very quickly, pulls back here for, maybe, a week and a half or so, and then builds a little cheat area and a handle, and then boom, right into new high ground again, another natural reaction, new high ground, natural reaction, new high ground. Now, again, after you go through this a bunch of times, you get extended, the stock's up, and now you've got a nice profit on it. Yeah, then you're going to start looking to sell into that strength. But what tells you to hold a stock, or at least for me, if the stock breaks out and then gets through that first natural reaction, gets to new high ground, I usually try to go through another natural reaction and let it pull back again and see if it can recover again, because it proved that it is able to be resilient.
Yeah, and I said this early on another segment. One key to do is to study these second stage moves as the stock is moving higher, and you'll get in your mind exactly how these reactions should play out. So look at some of the greatest winners and look at the moves that they're going through and what happens on these pullbacks and what happens when they keep on moving higher.
Yes, and you're going to notice something very consistently that happens over and over in the better stocks. Now, something else that happens, and we're looking here at a weekly chart of that same CENT that we just looked at. So here's that big base, but on a weekly, and you can see the same exact thing, the same exact thing plays out on the weekly as the daily. You can see the volume comes in here in the handle area, and as it breaks out, the big volume on the weekly, big bar, natural reaction. Now, this is going through those natural reactions, but then you can see here, you come off and you take a bit more time. Now it's 1, 2, 3, 4, 5, 10, maybe 15 weeks or so. And here's the key. Once you go through several natural reactions, usually 2 or 3, if you're going to try to play a stock for a big move, then you're going to have to go through usually a shakeout and some larger bases. And what that means is not only going through a larger pullback, but also more time building a base and most likely an undercut of a previous low. This happens over and over and over. That shakes out the weak holders and will trigger a lot of stops. This is something that David talked about earlier about the shakeouts. Now, that won't normally happen in when you first have those first natural reactions. And if it does, it takes out a minor low and it doesn't really put any pressure on you. But when you have these larger later on, as the stock gets extended, it runs up. Maybe the stock is up, well, from here, it moves up out of about $16 and then moves all the way up to 28. And you're talking about this stock's up, 80, 90% now. Now you're going to get some pullback and some basing. So you'd probably be selling some here. But if you're trying to hold it for a bigger move, now it undercuts that previous low. And then you can see, look at that, it comes ripping back. And then you get another sideways action. Again, see, it shakes out the low before it can move higher. So as you get later and later in the maturation of this move, you're going to get more and more volatility. There's going to be more profit taking, and it's not going to be as nicely and as efficient it is in this big move. This first move. That's why I tend to swing trade, because I like that easy, quick money and the least amount of risk and volatility. And I'm really looking to get the quickest, easiest dollars.
Yeah. The other thing I would mention on the shakeouts should happen quickly. And you see this came down below. It came down below that low right here, and it was there for. Since it's a weekly chart, I can't tell, but it might have been just a couple of days, and then it turns and takes off. And that's what a shakeout should do. It shouldn't sit there for weeks and weeks and weeks and weeks, because then you run the risk of the thing really starting to fall off. But when you go through those lows, and I look for them all the time, when I see it go below that previous low that occurred there, and then goes and turns, I might even start buying it before it comes back above the majority of the base. And you can see it on the second situation too. It looks like it hit it, undercut, and came right back off, and then it was off to the races. The other thing I wanted to point out, which is kind of interesting, is I mentioned this earlier, where when a stock starts its move, you want to see huge volume, and you're getting it here and there and there. But once that stock really gets up and going, it doesn't take a whole lot to keep it going. It's like the spaceship example that I've used, where you want the big volume off the launching pad, but once it gets into orbit, then it can keep on going. And then you can see that. Look how the volume has declined, but the stock has been moving up along the way. And that's just telling you that you've got a lot of institutions in earlier, and there's still continuous buying. But this stock might be getting near the end of its move after it's already doubled and the volume is now really drying up.
That's right. You want that volume on liftoff. And we'll show you another example here, looking at the symbol AMAG, a daily chart. This is one that I actually bought coming right out of this power play setup. And you can see the stock moved up about 50%. Once it makes a decent move, and you can see the first few moves here, there's very short-term pullbacks and right back into new high ground. These are just natural reactions, tennis ball action, but then you have to go through some pullback and an undercut of the previous low. Now that the stock's up, then you make another move here, and again, you can see how it was very briefly, like Dave said, very briefly, and it turns right back up. Same thing here. Look how it shakes out the low and then comes right back. So again, if you're going to play for a bigger move, you're going to have to go through some of these shakeouts and go through some bigger basing. Now, we want to talk about what you want to see. We're going to talk about what you want to see, and we're going to also talk about what you don't want to see. So we'll start off with what I call bullish confirmations. And these are the things that I look for and Dave looks for. When the stock breaks out, we're assessing the quality of the breakout and whether that breakout is giving us an indication that it's institutional buying versus retail buying. So and Dave was starting to mention this before about he wants to see that, right away the stock not only at a profit, but follow through buying. So the first thing is follow through buying. 2-3 days or more of follow through buying is always a really good sign. And Dave, as a matter of fact, I remember, when I listened to an interview with you, this was back in the mid 80s. We're talking about a long, long time ago, 30 years or so. And I remember, one thing stuck with me forever was that you said, I want to be at a profit right away. And that my best trades are almost always the ones that show me a profit right away. So would that even could we go as far as saying the better ones would even show, several days of follow through buying?
Oh yeah. The more volume you get, the more up days in a row that you get, that's just telling you everybody is recognizing, hey, this is a great situation, and they can't get enough, so they have to be in there more than one day. And as I said earlier, especially with institutions, sometimes it takes them weeks to get their position filled.
Yeah. Another thing that Dave and I look for, and again, getting more forensic here and really starting to look at the quality of the breakout and those days that are subsequent of the breakout, we're counting days. We take a look up versus how many days are down. Also, within that, you can look at the closes and see how many days had good closes versus bad closes. And we want to see more up days than down days, more good closes than bad closes. And of course, we want to see tennis ball action after the natural reaction. Let me show you what that looks like.
Yeah, and just to describe a good close is something that's closing in the upper half of its trading range for the day. So that's, you don't want it to be on the low of the day. You want it to close if the best ones are the ones that they're buying it all the way through the day and they're closing on the high of the day.
Right. Here's Yelp, and this is a perfect example. So you can see that it comes through right here, a little cheat area, right? We talked about the cheat entry. Comes through the cheat area, pulls back 1-2 days, and just builds another pivot. This is a low cheat. This is a cheat, right? So you can see you get the 1-2, right? You get the 1-2 punch. The volume comes in on the breakout. You get the volume, and you get some subsequent volume when you come through that next pivot. But look at what we see here. If we count the days here and we take a look from the buy point, 1, 2, 3, 4 days, right? 5, 6 days. We got 7 up days out of 9 days. And look at the closes. The closes are all, some of them right at the high, and all of them are good closes. We got a lot of good closes, maybe one in the mid of the range here, but this is a really, really high quality breakout here. We're counting the days here, 7 out of 9. Sometimes you'll get 8 out of 8 days up. I've seen 11 out of 12 or 13 out of 15 days up. Now you get the natural reaction. And you see, this is a very small reaction. It only comes in a little bit and back into new high ground. That's not a stock that you want to sell all your position right there. It's just acting too well. It's showing that not only is big money piling into it, but it's supporting the stock and there's very little profit taking.
Yeah, and if this is the first base that this stock is coming out of it, if it's coming out of a long base and this really is one of the first big moves that it's taking, this might be a stock that's a leading stock, and a stock that's going to go not just for a couple of weeks, but it's going to go for months and months and even a year and a half or 2 years if you're at the start of a bull market.
Right, especially if it's coming off of a correction or a bear market. So here's BITA, right? Another VCP setting up nice and tight here. You can see comes in nice volume on the breakout here. 4 out of 5 days up. See, 1, 2, 3, 4 days up out of 5 days up. Look at the volume, and then you get that one. Look at that one big scary day. Now that sometimes will knock people out of the stock. They'll think, oh no, there's something wrong here. No, that's perfectly normal. The stock ran up for 4 out of 5 days, and it's just pulling back, and it hasn't even come back to the breakout. And then you can see just a few days later, you're right back into new high ground. Tennis ball action, right? So classic action. And as Dave just said, here's a stock that came out of this base here and went up 500%, 478%, close enough, in 11 months. So there you go. I mean, this is just the very beginning. Let's take a look at baby stores. So this is one that I was buying here, coming out of this textbook perfect base here. Just a nice tightening up on the right side, very tight pivot. Take a look here. 3 out of 4 days up, and you see the volume. If you look very closely here, those 3 out of the 4 days, look how big they are, and that's the only day that it was down, and it actually had a good close. You see right here, it was very low volume. So great volume characteristics during those 4 days. And then your natural reaction is just a little pullback, 4 days, and wham, right back into new high ground. Then you get this one sharp day, right back up at its highs. I mean, just, classic action here and acting perfect. And then as Dave, I think you pointed this out earlier when we looked at another chart of the same stock, you get a mini little base right here with a little handle or cheat area right here. And you're starting all over here again, tennis ball action once again.
Yeah, and in most natural reactions, they don't retrace that much. As Mark said, look how this was contained within that 1 day of trading. You have 4 days where it pulled back and it pulled back on lighter volume. That's exactly what you see. What you don't want to see is you don't want to see 3 big days in a row that are down and down on big volume. That's telling you, wait, there's something wrong, and maybe this was just a bad 1 day breakout. So
Right.
small
Right.
reactions down is what happens on the initial breakout.
Yeah, and I think another general rule of thumb that I can segue off of what David just said is that if you first break out, you come out of the base, and maybe you're up a few days, and you're not up much, maybe 5%, 4 or 5%, 6 or 7% even, you could pull all the way back to the breakout and even undercut it. That happens. That wouldn't be a big retracement that you'd have to get too worried about. As long as it recovered fairly quickly, got back into new highs, took out the high of that first run up, the high in the natural reaction. Now, if you're up though, and the stock is up, Dave, now this stock, let's say, goes up 25, 30%, and then comes down and erases all of that gain. Now, would that be natural?
Yeah, no, that wouldn't be a natural. That's much more than just a natural pullback. That's
Right.
that's almost like really a breakout failure if it comes all the way back into the base, and especially if it does it on bigger volume.
Right. So that would be a full retracement of a good sized gain. So you never want to allow a stock to retrace a good sized gain. Let's just say you buy it and you get, you're fortunate to have it go up 20% in that first leg up. You would absolutely want to move your stop to break even at that point. You should never let a 20% gain turn into a loss. And that can happen. You might get a full retracement, right? Might come back in, but at that point you have to say that's not natural, and you may feel foolish taking a break even on a stock that you once were up 20%. But you'll feel even worse if you take a loss on it. So
yeah, and I'm sorry. Then the other thing I wanted to point out too is as the move goes on, and as you get these tennis ball action and then the pullbacks, is that eventually you can start using the moving averages as support, and that's what this one did. You see, it got support on. I guess this is probably a 50-day moving average that this stock comes down, and that's what contains natural reactions as the stock is moving along in its run.
Yeah, I think that's the 20-day on this one, but yeah, the 20-day and the 50-day on that first move up, usually you'll get support around the 10-day moving average and the 20-day moving average, and then after your intermediate term pullbacks, especially when you get those shakeouts, you might get back down to the 50 and find support there, particularly on the first time it pulls back to the 50 after it comes out of a base. Let me give you a few more examples here. So this is symbol GOL, of course, airline stock coming out of, again, a really nice formed. This is just a classic cup with handle, VCP characteristics. Look how nice this breaks out. I mean, and you can see the volume comes in, again, the 1-2, right? Here's the low volume. Here's the big volume on the breakout. And now you're up 8 out of 10 days. And again, this actually shook out a low, but as Dave said before, look how it's just 1 day, it closes right up at the high, and then bingo, right back into new high ground, tennis ball action, right? Then another natural reaction, and in just 1 day, you're back into a new high ground. Dave, another thing that, as a matter of fact, this is something that I learned from you. You'd like to look at the stock, and when it pulls back, if it comes back, let's say, 5 or 6 days, and then can just make up all that lost ground in just a day or two, you actually give the stock props for that, because that's showing that it's very resilient. And if it's just the opposite, if it just grinded its way higher, but just come and then erased it all in 1 day, another way of looking at the quality of those days, right?
Right. You just don't want to see the stock give up that much, and you don't want to see much volume. You're really trying to track the big money, and if this is going to be a stock that's going to be very successful, they're going to buy over multiple days, over a couple of weeks. The reactions are going to be small. There's not going to be much volume on the reactions. And if there are just these normal reactions, you're going to get more volume coming back in as these institutions maybe even buy more of a position on this move.
Right. So as a general rule, you'd like to see the recovery from the natural reaction take place in a less number of days than the pullback. So just as a general rule. So here's Zillow. Again, we looked at many of these before when we're looking at pivot points, and now we're looking post breakout, right? So we saw this before as a cheat area. You never really got a handle. Again, look, 7 out of 8 days up. Very nice. Just boom, 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 up, up, up every day. Very nice. Look at the natural reaction. I mean, if you even call that a reaction, it just goes sideways, super, super tight, right into new high ground. Again, just a very brief 1, 2, 3, 4 days down. And look at how it comes ripping back. Again, this is a stock that you're going to want to probably hold, or at least hold some of it. If you're coming out of a correction, a bear market, this could be a key leader just starting a big move. Let's take a look at REX. And you're going to see, again, over and over and over, these similarities. You see here, again, similar to Zillow, you get a cheat area, but you don't really get a handle. You get a pause here for just a day. 5 out of 6 days up. See, this is what David was talking about, where he wants to see a profit right away. And the better that profit is, and the faster and the better volume that you see, and the number of days and the closes, we're looking at all that. That's how you get these, this forensic look at the quality of the move coming out of that base. And we can tell if it's something that's, telling us that it's acting really well or not. So it's pretty straightforward, though. You're going to count the days, look at the quality of the closes, and then look at the subsequent pullback and how fast you can get back into new high ground. And that's really, what you need to look for post breakout. Now, Dave, we're going to get into looking at something that you call the MVP indicator, and something that Dave had termed, and I think, as a matter of fact, at O'Neill, didn't you call them ants when it first started?
I called them ants because the programmer I worked with, to have it show up on the chart, he would put a little dot on top of the price action when it started occurring. And the longer it went, the more days up in a row that you had, you would keep on getting those indication, and they would look like little ants on top of the chart.
Yeah.
And so then I've tried to put it into something else that you can look at. But here are the criteria, and you can see number one, you want the stock up more than 20% or more during this 15-day period of time. Also, you want 12 out of 15 days in a row. And you don't have to, the starting point doesn't have to be right when the stock is breaking out. It actually can start in the base. It can start at the bottom of the base. It can start even when the stock is extended and it keeps on going. You just want to see this occurring somewhere along that, especially the initial move. Because what this is the institution that can't get that position in 1 day or 2 days or 3 days, but they have to do it over weeks. And so also during that same period of time, you want I would say a 20 to 25% increase in volume during that 15-day period. And the way I came up with this is that when I was running a mutual fund for William O'Neill and Company called the New USA Fund, it was a growth fund, and I was buying, and I would stop my buying when the stock got extended. It would break out, go through the buy point. It would be up more than 10%. We would use 10% at that time. And then I would see the stock just keep on going. I stopped my buying, but the stock just kept on going. And I started studying those stocks that had started having these huge runs, and I found that these were the characteristics that were found in stocks that are institutional buys that people are just getting started with. And these were the ones that became true market leaders, and the ones that went on for a year and a half or 2 years.
Right.
It just shows that huge buying.
So let's make one thing clear. Buying extended stocks is dangerous. So you don't want to buy stocks when they're up too far after the pivot point. However, this is something that you want to, once you buy the stock, if you should get this criteria and you get this very bullish breakout, this is clearly a stock that you want to hold and give more time, because it's showing you incredible strength. And on top of it, if you might even want to buy it on a pullback or a subsequent base because it's shown you such strength that, as Dave said, these are the characteristics of stocks that make really big moves and are under very intense accumulation. You can see here, this is Google. And again, just putting it all together, right? We've got a recent IPO. We go through a little correction here. You get, and I remember I pointed out how using the load sheet works really good on those big cap IPOs, and you get it perfect here. It comes right out and then runs up 7 days in a row. You get 7 up days in a row, natural reaction, tennis ball action. And then when it comes out of that and you get that tennis ball action, now it's meeting Dave's criteria here, and it's telling you that this is a really, really strong breakout that probably has institutions piling in there.
Yeah, and Mark, you could actually, I point out to that day, you could start the count here. 1 day up, 2, 3, 4, 5, 6, 7, 8, 9, 10 days up in a row, 1 day down. So it's 10-1, 11-1, 12-1, 12-2, 12-3, 13-3. I mean, 14 days up and 3 days down. That's showing you somebody's buying and buying big. And one other thing,
where's that? That completes right over here somewhere.
Yeah, it's yeah. I think even right up here. But you could start all the way back up at here. But 10 days up in a row and is very, very unusual. Right. The other thing too is, let's say I missed this stock when it came out of that initial base, and it's up here and it's building a whole new base.
I don't see your pointer, Dave. You're saying up here. And
I'm sorry. Even when the stock, let's say I didn't get this stock, I missed this initial move from 55 all the way up to 100. I like to go back and look to see was this institutional buying in place during this first move. And as we counted, yes, it was. It just gives me more confidence that there are some big institutions in there getting their initial position in the stock. And at the second base, if I missed it here, I could get it on the second base. But it just gives me more confidence that this is going to continue even higher out of the second base.
So using that as sort of a qualifier, you see that type of action, and now the next base that forms, that you should be really looking pretty seriously at that, because now you've got that previous accumulation. Yeah. Okay, just real quick, let's take a look here at National Beverage, symbol FIZZ on a weekly. So I just want to point out how, whether you're looking at the weekly, the daily, the same, everything is going to apply. Big base here comes to a nice pivot on the right side here, 2 weeks, breaks out again, natural reaction, tennis ball action, natural reaction, tennis ball action, same exact thing, 400% in 25 months coming out of this really well-formed base. And you can see again, see the volume here, nice and low here during the base. And then as it comes out, you can see the weekly volume starts to come in, and then it really starts to accelerate. Let's take a look at another weekly chart. Yeah, this is Netflix.
Yeah, again, Mark, that last one I did that count too, and it had that 12. Yeah, if you start, if you start right here, that's day one.
Again, I can't see we can't see your pointer. You keep saying here.
Oh, did I draw it in?
So you're probably talking about right from here.
Yeah, from right there.
Yeah, 1, 2, 3, 4. Yeah, 5, 6, 7, 8, 9, 10, 11, 12. Yeah, you're looking at 12 out of 15 in this first move up here, right here.
First move up, yeah. And then
so on a weekly, and then we're looking on a weekly, of course.
Oh, that's a weekly too. Well, that's even more powerful too. If you get it on a weekly basis, that's just telling you this is very, very unusual. Very good buying.
Yeah. And so let's take a look at Netflix here again. Coming out of this base that I was buying back in 2009, going into 2010, and you can see comes out 6 out of 7 weeks up, and then this just drifts all the way back. This took a little while. This did actually take some time, and was starting to look like maybe something was wrong, but then it just comes ripping back. Look, in 1 week, and the reason why I put this example is because I wanted to show you how it grinds back here for all these weeks, and then it erases everything in 1 week and rips to new highs. That is what I was trying to point out before about that's what you want to see, and the opposite of that would be that it grinds higher and then just gives up everything in one down move. So that is very bullish and would be bearish if it was the opposite, of course.
Yeah, the other, if you see where my X is, even though it grinded down, it looks like most of that volume was very, very light or under average weekly volume. So that's a good sign. And then you get the explosion in volume, bigger than anything that's ever traded.
Yeah, and to get even a little more forensic on it, if you look at the one week that it did have elevated volume right here, it actually had a close that was not too bad. It actually looks supportive.
Yeah, in mid-range.
Yeah, mid-range close.
Never went through that low of that week either.
Right. So let's take a look. What do all the previous examples have in common? And I can tell you right now that most of the really good breakouts in stocks coming out of these VCP bases, if you've done your homework right and everything's correct, you're going to see usually where you're going to have all of these things in place. And that is, number one, profitable immediately. Number two, follow through buying. Maybe not the first few days. You might have one day breakout, you pull back a little bit, but you're going to see follow through buying fairly quickly, usually within the first week or two. If you go, you're going to look at and you count more up days than down days, more up weeks than down weeks on a weekly, more good closes than bad closes. Tennis ball action, of course, that's the main characteristic if you want to see tennis ball action, and good volume characteristics, meaning that you've got high volume when the stock's moving up, and when it's pulling back, you're seeing low volume. Now, let's look at the opposite now. We're going to look at bearish violations, okay? We looked at bullish confirmations to give us an idea of what would tell us to hold the stock and that things are acting normally. Now we're going to look at what would tell us something might be wrong with the stock. And the key with this is, with any one of these, you're probably not going to just sell the stock. You'd still stick with your stop loss, because this is within the first few days to week or two after you buy a name. You want to set that stop and give the stock some room. However, if you start to see these piling up and there's 2-3 violations, then you might want to start reducing, or even if the violations really look bad, kick the stock out and sell it before it hits your stop loss. So the first one is, and we're going to go over each of these, but low volume out, high volume in. We'll explain in a second. 3 consecutive to 4 consecutive lower lows. Right at 3 consecutive lower lows, I start counting the lower lows and looking at the volume with no supportive action on the 3rd or 4th day. The more lower lows, the worse the scenario is, the more ominous, let's put it that way. And just the opposite of what we counted before, more down days than up days, more bad closes than good closes. And the 20-day and the 50-day moving average, I'm not big on moving average crossovers, and if it gets below the moving average, it's a big deal. But we've done the studies that looking at these stocks subsequent to their breakout within the first few weeks, and if they close below the 20, it takes the probability down of success, and the 50 takes it down even more. So this is important right after a breakout. Right after a breakout, you should hold those. If you're coming off of a low cheat, you might actually be below the 50-day already. That's possible. But most of the time, you're going to be above 95% of the time. You're going to be above the 20 and the 50, and that's important. And wide and volatile price action also is not something that you want to see too much of subsequent to a breakout. Let me show you what this looks like, all right? And this was Lumber Liquidators. I remember when this set up, this was a late stage base. It was a flawed base. I did not fall for this, but I'm sure a lot of people did, because the stock was very popular at this point. It had made a big move. It was a market leader at the time. And so it broke out of this base that wasn't the greatest base, but it came out right here. And you can see right away there. Let me get the right pointer. Here we go. Right here, you break out, and right away you can see that there's problems, right? The next day comes in, but then it comes in another day and comes back into below the breakout, tries to rally, can't really rally very much, and then has a pretty bad close on that 1, 2, 3, 4th day after the breakout. And then look at this, wham, comes in, and look at the volume. That is the exact opposite of what you want to see. And if this had not hit your stop well, you should be getting out, and this most likely would hit your stop. But this is a sign to clear cut run as fast as you can. You've got what I call low volume out, high volume in, and you close below the 20 and the 50-day line.
Yeah, and Mark, what that really also is well, it's a breakout failure, and it's sort of opposite of when earlier on in this segment we were talking about shakeouts. Well, this is a breakout that shakes that then comes straight back down, and that's one of the worst signs that you can see. Because the other thing too is, think about it, there's no add-on buying, there's no institutional buying. What it was is probably a lot of technicians, a lot of chartists are going, hey, this stock looks great. It breaks out one day, but there's no additional buying. There's no big money in there buying day after day, and it completely collapses quickly.
And if you remember what I said earlier, I talked about how we're trying to decipher whether it's institutional buying versus retail. Well, this clear cut tells you that this was just a retail breakout, and the institutions actually are selling the stock. So you get it breaks out on a retail breakout and then comes in, and this is institutions. And if you see this day, this is one of the largest, or certainly in this chart, this is the largest down day and one of the largest down days since the beginning of the move. And that's always a very bad sign too.
Yeah, and there was very little volume on that breakout also.
That's right. Yeah, that's the whole, that is actually what you're trying to assess. When I say low volume out, high volume in, most of the time the breakout will actually be on low volume. However, even if it's on high volume, let's say it's a fairly decent breakout and the volume's elevated, but then the volume is much larger when it comes back in and it breaks, that's still considered low volume out, high volume in, because the volume coming back in is much, much higher than the volume coming out. Here's another example. So you got low volume coming out right here. You got a pivot here, it drifts back. And this, looks pretty good. You've got a good sized base here. You come up on a gap, you drift back here, kind of nice and tight. And now it breaks out. So, but look at the volume's not very strong. And then it comes right back in, and the volume comes in here, and that's low volume out, high volume in. That would be a strike. Okay, that would be one violation. Now, would you necessarily sell this? Maybe not. But it certainly, this is one of the big warnings, though. If I see this, I'm watching very, very carefully. Then the next thing I'm going to tune in on is the number of lower lows, not just down days. We're not talking about down days. We're talking about a low that takes out the previous low. Now, this is magnified if it's on big volume. If it's on big volume, and especially if the volume is getting heavier and heavier and the days are getting larger and larger. So the quality of the lower lows you also have to assess. But the key is to watch right after the breakout. If you get 3 lower lows and you can't rally on that third day and get a decent close, every lower low from that point forward is another strike. It's another big strike, especially you get 4 or 5. Now, you might get 3, 4, 5 lower lows and you haven't hit your stop yet. And maybe it's on big volume coming back in, low volume out. So now you've got low volume out, high volume in, let's say 3 or 4 lower lows, not very good closes. Now you've got several strikes, right? So now the violations are starting to pile up, and then we get a close below the 20-day also on that third lower low. So now we have another strike. Now that's 3 violations. So at that point, you want to, the probability of the trade working out is getting less and less. As these violations start to pile up, the probability of the trade working out is getting less and less, and you should adjust your position size accordingly. You can see here, we actually went down 4, 5, 6 lower lows when it was all said and done.
Yeah, the other thing this is something that I discovered when I just started looking at charts that had big moves, or stocks that had big moves up and then started coming down. What was the difference between the move up versus the move down? And it was 3 lower lows, and these lower lows, they're not just fractional, drops. These are fairly good drops, especially this last one here. The interesting thing, if you look on the way up, you only got, as I was trying to look at this closely as Mark was talking, is that you did get a spot over here where you got 3 lower lows. But that was on very, very light volume. And this is on volume that is increasing. So you can get it sometimes in the uptrend, but it really didn't come off much. It got support on that 50-day, had this undercut, and then took off for another run. So
that's a 20-day again, by the way.
Sorry, 20-day.
Yeah.
And so, yeah, so you can see the difference between an uptrend and a downtrend. The downtrend, the lower lows are on bigger volume and bigger price moves versus the other side if that occurs.
Yeah, and again, to get a little more forensic, you can see here on the fourth lower low, you got a good close, and then from there we start to stabilize. So once I get that third lower low, I start to watch, and I even watch on that third lower low to see what the close is like. If I get a good close, let's say you have a lower low and then it closes at the high of the day, okay, well then I might give it a little more time and see what happens the next day if we can come back, because that's where you're going. Like I said before, if a mutual fund or institution is buying that stock, they're going to support the stock on these pullbacks. As the stock got away on the breakout, it comes in a few days, usually 2-3 days down, they'll support the stock. If you're not seeing that support, well then that makes it all the more ominous. And every day beyond that third lower low, that you get another lower low, especially on volume, it's a worsening and worsening picture. And then of course you start adding everything else with closes below the 20, the 50, low volume out, high volume in, and you start getting a clear picture of that the stock is not doing what it's supposed to be doing.
And the other thing, Mark, too, I've seen stocks that have, when they go through huge moves to the upside, it's sometimes they never get 3 days in a row, 3 lower lows during that entire up move, which could be 100%, 150%. So sometimes you can almost stick with that rule. Unless it has 3 bad days in a row, you just stay long that stock.
Yeah, we're going to actually show that later on. That's a rule in selling, in the selling section, and we're going to show you something that's pretty amazing. Anyway, let me move on here. I know we're spending a lot of time on some of these charts, but we want to show you, this is how, people wonder how we do some of the things that we do with stock trading and think that we have some crystal ball. No, but we are looking very closely and we're very in tune with the nuances. And we've been doing this for so long and seen so many charts and have compared them to so many big winners and losers that we know what it should be doing and what it shouldn't be doing. And that's really all you have to know. Once you know when that train is supposed to be coming on schedule and you've got that, that map, well, then you have a reference point and you'll know if things aren't coming in the way they should, and then you adjust your position. Now, here's another one coming off of a cheat area right here. Perfect too, perfect setup. And that's another thing I wanted to point out. You can get a perfect setup and it doesn't, maybe the market's topping, and you get a late stage setup or even a setup that's not late stage, and the market comes in and you get a top in the general market, and you'll break these stocks down even though they're coming out of a very nice pivot. Just because it comes out of a nice base doesn't mean it can't fail. You're still going to have, most likely, half of your stocks are going to be losers when it's all said and done, and you run your numbers over any length of time here. But just to show you here, this is one that I actually bought coming out right here, and I'm just going to go through exactly what I did. So it came up for a few days, and then that had that big retracement that came right in here. And that was, you can see there was big volume. So I counted that as low volume out, high volume in, and a full retracement, not of a big move. So it wasn't like it retraced 20%, but enough for me to say that I need to reduce here. So I cut my position in half. Then a few days, it can't rally much, and we get a 3 lower lows and then a 4th lower low. And it does have an okay close, but now I'm below the 20, I'm below the 50. I've got 4 lower lows. I got low volume out, high volume in, a retracement, no follow through on the breakout. I mean, there's just all kinds of violations piling up here. So I sold the rest of my position there, and you can see then it rolled over pretty hard just a week or so later. Let's move on to take a look at BW. So again, this is not one that I was involved in, but you can see it came out of a base right here. And then you got these 4 lower lows, which at that point, this would not be a violation. Like Dave said before, these aren't very big days. There isn't really big volume. It's still above the respective moving averages. So again, I'm not too concerned right here if I'm in the stock. However, now you've got this natural reaction, right? you should be getting back into new high ground here, seeing some supportive action. And what happens? Nope, you get a pretty good sized down day, and look at the volume. The volume picks up pretty dramatically. So now you've got volume that's bigger coming back in than you had coming out. Low volume out, high volume in, 4 lower lows, and now it's also closed below the 20-day, and then a few days later, it closes below the 50-day. So now, again, you've got these violations. Now, you wedge up a bit here, and if you were still holding it, this is really coming to where it's got to perform here. Now you go for a number of weeks, it comes off again, takes out these lows, and this is really the final straw. If you weren't selling here, then you're really not paying attention to what's going on in this stock.
Yeah, and Mark, I want to point that out too. I was talking about when a stock is in an uptrend, it's correcting down to the right, say 4 o'clock on the clock. But then, as you pointed out, this thing is wedging, and that's going up to the right, pointing towards 2 or 230. And the other thing I also see, dramatic change in the stock, is it gets hit for 3 days. And it's on these last 2 days, it takes, as you said, weeks.
Where is that, Dave? Because I'm not sure where you're pointing out. Okay, I'm just going to clear this.
See here, the stock gets hit right where your arrow is. On 3 days, it comes off, and then it takes 3 weeks, 2 or 3 weeks, to retrace what it lost in just 2 or 3 days, and that's showing no power. It's completely lost its buying power, and so then it slips, and look how quickly it slips. And so the whole characteristics of how the stock trades is changing, because it now comes down quickly, and it takes forever to rally, and here it comes down quickly. And see, it's wedging up to the right. You're an observer. You're looking for a change in the characteristic of how the stock is trading, and it's dramatically different from the uptrend to a new downtrend.
Now, keep in mind, we're showing you blow by blow here and really deciphering these. If you're just starting doing this, you're not going to be able to do this in real time too effectively in the beginning. You're going to miss a lot of things. You're going to have to spend a lot of time studying these charts. That's why you have this workbook material where you can go back, you can compare. It's going to take time. This is something that Dave and I have been doing for decades and decades and decades, and we've seen literally millions of charts and traded hundreds of thousands of trades. So it takes time, but once you do get the skill and you've narrowed it down to looking at the things that you really need to be paying attention to, you're going to have x-ray eyes. I mean, you're really going to never get yourself too far off track. You'll never get in real big trouble because you'll notice the warning signals pretty quickly. Another thing I want to talk about here, let me show you just to follow up on something that is even more ominous, and that is once a stock has a pivot failure and starts to produce some of these violations, if you get what I call a ledge, where you just you walk sideways here and even drift higher, as Dave was saying, if you're just drifting up, this is a very negative occurrence. And the reason is that, or I should say, something that William O'Neill said many years ago when I met him. He said that the best thing a stock can do is rally and not pull back much, and the worst thing a stock can do is break and not rally much. So meaning that you want stocks that, again, are tennis balls, and the ones that come down and can't rally, those are showing that they're weak. So this stock here tries to come out of this base, and then even tightens up, and it looks like maybe it's okay here, but then comes off and just straight sideways. And this is what I call the ledge. After you get a pivot failure or a base failure, if you get a ledge where you just go sideways, that's actually, you might want to look at shorting. You certainly would not want to go long, and you have to be really careful. We actually put this stock right here on our short list. This was Michael Kors just before it topped. This made a pretty big, had a pretty big decline subsequent to that. Let me show you a few names and how they look, not only forming the ledge, but what happens leading up to that. So you can see here, you get a one-day breakout and then no follow through. Instead, you get two pretty good sized reversals, one bigger than the other, and a big outside day here on fairly decent volume. You get the 1-2 coming out. Looks great coming out. Perfect little pivot right here, a little shakeout within the pivot. Everything's looking great. But now you get a few reversals. Now, this is not enough really to say I'm going to sell the stock. Even though this looks, not exactly what you want to see, this could recover and be back in new high ground very quickly. Now you get 1, 2, 3, 4 little days wedging up, right? And then the lower lows, 3 lower lows, close below the 20, below the 50, volumes coming in. I mean, everything is just happening in the exact opposite fashion that you'd want to see to show that the stock's healthy. And that's just the very beginning. Then you build the ledge, and then you really start to come in. So again, just going day by day and assessing whether, if you counted the days here, you don't have the first breakout here, 1 day, 2 days out of 5 are up, right? And this is just not showing you any kind of tennis ball action whatsoever. So you're just not seeing what you need to see here to continue holding the stock. Okay, another one here, real quick, just to point out, you get a nice gap here, and then you form this little cup with handle. You break out, but look, 3, 4, 5, 6, 8 lower lows. And this is just coming right off here. 8 lower lows is definitely ominous, and then you can't rally at all, and it wedges up, and that's when it starts to break. A general rule. Let me just give you a general rule. That is, always look whenever you're looking at a base, a consolidation in a stock, always look to your left. I say look to your left for traffic, like you're crossing a street and it's a one-way and the traffic's coming from the left. You're looking for supply, and you always look to the left, and you'll find that, and this just goes back to what David was talking about drawing a line. If we just go right here and we go across here, you can see that, look how right here at the between the $48 and $50 level, right at the $50 level, we have all these reversals. Every time it comes up to this point, you get a reversal. You get a reversal. You get a reversal. You get a big reversal here. So this is your area of supply, and that's where you want to see the price tighten up, quiet down to give you an indication that supply has stopped coming to market, and then punch through there from that tight area. This stock just the opposite, right? It cannot. You had a little setup right here, tried to come out right back in. Just never really gives you a tight enough area to really conclude that the supply has stopped coming to market, and then it breaks and you set up the little ledge here, and that's where it rolls over. Just real quick, one more before we wrap up this particular part of this section, and that is, always be prepared for the opposite side of the trade. All right. And what that means is that if you're long, always prepare to sell, to go to cash. If you're in cash, always be preparing to go long. And never think that a stock can't get into big trouble really quickly. You start seeing these sell signals or these violations, you've got to make sure that you protect yourself. This is a stock I wanted to point this out because everything looked, nice and dandy right here, coming out of a really nice tight pivot. Look, the volume is beautiful, comes down, and then you get that nice volume coming out. You even get a natural reaction, and you get tennis ball action. But then you get 3 lower lows, and it comes in hard. You got a huge volume back into the base. So, low volume out, high volume in, 3 lower lows below the 20-day, and then just wedges itself down here, cannot rally at all. This stock went down 99% in just 3 months. So just keep in mind that all stocks are tremendously risky.
Yeah, and I think what people tend to do is, if they've been with a stock for months or even over a year, it starts becoming almost like a child to them, and it can't do anything wrong. And so you have to have that very neutral mindset every day when you're looking at your stocks. Don't play little favorites with it, and then it's like your children. You should just be neutral, analyzing day after day as that stock moves along.
Right, and that's why we have rules to keep us objective and honest, and to make sure that we're assessing what the stock is telling us, not what our opinion is. And so looking at those violations now, and looking at all those examples that we just showed you, what do they all have in common, right? We looked at the bullish scenarios. Now the bearish scenarios, what do these charts all have in common? One, lack of follow through. Didn't have much follow through buying. More down days and more bad closes than up days and good closes. And the volume dynamics were not good. Instead of having that powerful volume and then light volume coming back in, we had just the opposite. We either had light volume coming out and heavy volume coming in, or maybe even heavy volume coming out, but even heavier volume coming back in. And those are poor volume dynamics. And then we had reversals, and we saw closes below the 20-day and the 50-day soon after the breakout, and no tennis ball action. So just, the opposite, the exact opposite scenario as we saw with the positive scenarios. Now with the bullish stocks. So when you know what to see on the bullish side or the confirmations and what are the violations, you can see how the contrast between the two and really start to see the difference between a stock that's acting normal and a stock that's acting abnormal.
Yeah, and Mark, again, the way they can study this is just take a great stock that's had a big move up and a big move down, draw a line right where the top is, and compare the left side of the chart and the uptrend with the downside. And they are, as you've said, total opposites.
That's right. During the downtrend, you're going to see the mirror image of the uptrend of all the characteristics. Now, sometimes you'll get a stock that will break out and it does have a pivot failure, and you see some of these violations. It doesn't necessarily mean that you should scratch it off your list. I know, Dave, that we've said this before and many times, and I do the same as you, where I always keep a list of the stocks that I had bought and recently bought, particularly the ones that, might knock me out on just a small pullback, but came out of a really good base and maybe had all the characteristics. They had the fundamentals, but knocked me out in a few days. And so I keep a list of those. So are you sometimes going back in a name that maybe knocks you out?
Yes, and if I could use a recent example, Advanced Micro Devices, AMD, was sitting for most of this year, sitting there, and it looked like it was going to break out, and I played it once. It failed. Tried it again. I must have tried that 3 or 4 times, and finally, I got my position, and the stock followed through. It got great earnings, and it got a news that Intel was far behind in terms of their product versus AMD. And that thing had a tremendous move and is still doing well. So yes, you can't get mad at the stock if you played it once, it didn't work, or played it twice, it didn't work. Just wait and wait. And that's why you take small losses on these things. Sooner or later, if it's a great stock, it'll break out and you'll go along with a huge move.
Yeah, so I did the same thing with AMD. I played it a few times while it was trying to form that base. It was moving sideways from, and I don't have a chart here, but I actually have a chart on another screen over here. I have MarketSmith up in another screen, and it moved sideways from, looks like started in April, May, and I played it in there somewhere, I guess, around June or so. But then on 7/22, that's when it came out of that base and really kind of concluded that large base, and then came out of there really powerfully. So yeah. I did the same thing, Dave. This stock right here, Craft Brewers, is one that I also traded, and it was a real heartbreak because it reset. And what we're talking about here is a failure reset. There's 2 types of resets. One is a pivot reset, and the other is a base reset. One is more ominous than the other, and takes more price action to reset it. A pivot failure is simply breaking out, and then subsequent to that, taking out the lows in the pivot, and so you get the pivot actually fails, and you might get knocked out either on your stop loss percentage-wise, or maybe it's hit some of those violations that we talked about. But what I like to do is watch that stock for the next, several weeks and see if it can reset. And this particular one, for whatever reason, I did not buy it on the reset, and it was a beautiful reset. You can see this pivot right here is super tight. And if you come down, the volume is same exact. And remember, I'm just going to point this out again. Everything that we talk about previous, we build on. So nothing negates what we previously talked about. So the same rules are going to apply. You set a pivot and you reset. Well, you want to see the volume very drying up in the pivot, nice tight price action, and you still get the 1-2. Here's the subsequent action from this stock. And again, this just makes a lot of points that we've just gone over. One is, of course, we break out, we fail on the pivot, reset, breakout, 2 days up, but you get a close here on that second day on the lows, pulls in a few days, but then again, tennis ball action, right back at the new high ground. You see, just a pullback for 2 days, back at the new high ground, pull back 1, 2, 3 days or so, back into new high ground. This stock goes up 90% in 26 days. I had to watch this thing, go and just grind up every day. It was just brutal after I was in it right here perfectly. And then I failed to buy it back. I can't remember the reason why I didn't buy it back, but something had me form an opinion that I didn't believe that subsequent setup. So again, that's why we study these precedents and want to learn from them, from the mistakes that we make, and also from the successes that we have. So let me show you another failure reset. This is another pivot failure reset. You can see here, sets up here, not the greatest buy point here. This is a little short and not the best buy point. However, sometimes you'll get a buy point that is sloppy and you don't play it, but then it resets, it fails and resets, and that makes it even stronger because you'll suck in a lot of retail amateur players that can't really assess the quality, and they'll come in here, and that's where you'll get that reversal. But if it can then tighten up and reset, you might actually get a stronger setup that has spent more time moving sideways, and the pivot is even a better, a tighter pivot. And this comes out very nicely here and then works out, moves up 250% in just 7 months. So again, if you had bought here, you got knocked out and you weren't willing to go back in the stock, you missed a nice move there. I'm going to show you a few of these, and we're going to wrap it up for this section with the failure reset. And I'm going to show you a few creative resets too. You can get creative with this. You can, again, the resets sometimes can be low cheats. They could just attach to the base and create a larger base and be a classic cup with handles. This is really quite nice. And like I said before, you can get these breakouts. This really isn't the best base that it breaks out from. But again, this is a little bit sloppy and doesn't really have a great right side. So it fails, it shakes out, and then resets really nice. This is very tight, and that's really setting up. And again, if you were to draw a line, let's go back to what David was saying. Let me get my tool here. And you draw a line right across here. Look where the majority of the price action is, right? It's all happening right around just that 95 level or a little bit below. And that's where the pivot sets, and that's where you break out from. It's not at this old high. It's where the majority of the price action, and you get almost all the price action where it can't get through that area, is at 95. All right, let me show you another one. This is one, I can't remember, Dave, but I think you and I traded this off of this.
Yeah. Yes.
Right? Yeah. I remember that we traded Spirit Airlines, and it was a creative type setup. So it comes out of this pretty tight base here, but then comes back in, and forms a little low cheat here. This is getting, again, much more creative. And again, it comes right out really strong, 5 days up in a row, 10 out of 11 days up, and goes up almost 80% in just 10 months from here. So you might get where you got knocked out here, and then you even have a little shakeout here. It shakes out the low, but then gets really tight. Volume comes in and gives you this very creative low cheat buy.
Yeah, that shakeout. I love it. Look how far back that shook out. I mean, underneath the longer it is, the more people you get, the more weak hands you get rid of. Especially then, it comes right back very quickly, tightens up, and then goes.
Right. If you can shake out a key low, you got a lot of stops. I mean, down here, this would probably be another, very key low here that you're going to get a lot of stops. People buying this stock, this would be this low here would be where a lot of stops are placed. Let's take a look here. This is a pretty nice reset. This first base is actually very nice. Sets up really, really tight here. And again, I'm going to just draw a line across where the pivot is and show you. Look where the majority of price action is. See, it only traded above that level one time or two times, very briefly here, and never even closes above it. So this is buyable perfectly here. It comes out just right, but doesn't work out, comes in, and now you're probably stopped out here. This is too much of a decline from that initial pivot, probably for anybody with a tight risk tolerance to hold through. But now you come up, you tighten up, and again, you break out, you get a breakout attempt here. And again, this might have shaken you out too, and then you get a reset over here. But this base is really getting strong here now because you've gotten all these shakeouts. You got a base attached to a base here, really just a lot of action here across this price action around the 29 level or so, and then it resets. And then finally comes out here. You get 12 of 13 days up. Really nice breakout. So finally, when you cleared out all the supply and you went through all these shakeouts, you see how efficient when it finally moves. It's very efficient here. I should be using my little spotlight here to really show you it right here. Okay, let's show you another one. This is one that I traded. Now, I did not even see this stock. This was Dick's Sporting Goods, and I didn't see this stock until right here. It had upside guidance, and it had a big gap on the day. So I had started watching it right over here, but I wasn't going to buy it there because, of course, it didn't have any VCP action. And later on, it set up. But if you look at this base actually had a base right here. And if I was looking at this stock at this time, and this moved above these highs right here, I'd probably be buying it coming right out here. But it never even broke out. Another, reason why you should wait for the pivot to be breached.
Exactly.
And then again, I know you're definitely gonna talk about this shakeout because that's a pretty good shakeout, right, Dave?
Yeah, but I think your point is so. I think we should emphasize that when you shouldn't anticipate the break. I mean, you should be watching and waiting for the breakout, but just don't say, "Oh, it's going to break out anyway. Why don't I buy it now?" Well, you don't know what's going to happen, and that's what happened. It didn't break out, and so don't assume everything's going to break out. Wait till it starts moving through that pivot point.
Right. And again, let me show you right here. Let me just take this off, get my little drawing tool. So this shook out this low right here, right? And like Dave said before, we want to see the shakeout be brief and preferably come ripping back pretty quickly. And you can see it shakes out the low, it has a good close, and just a few days later comes ripping back an upside guidance. Now, I'm not going to buy it there. That's not where I'm buying it. I'm buying over here after it goes through the whole VCP process, tightens up, and then again, like Dave said, I'm not guessing. I'm waiting for it to actually break out and then buying as it breaks out here. I think we're going to look at this stock later anyway, the same name.
Yeah, and then if you go back, one last thing I wanted to point out is why don't you buy it, going through here? Well,
I can't see. Yeah, okay, there you go.
Can you see it? Yeah. This is the case where the stock has come from 8 all the way up to 12. So it had a 50% move straight off the bottom and without any resting, without any tightening. And then finally it does tighten up. And this is where your proper buy point is.
Yeah. Over here where Dave's talking about why not buy coming out here, because again, there's no VCP, there's no tightening. The right side is just wedging up, and you don't really get any time to digest that previous move and also digest the supply on the left side, like we talked about before.
Yeah, and anybody who's bought down in these areas, I have a 40-50% move, and some of them are going to take profits. So right when it goes into new highs, they're selling, and then it has to reset and get all tightened up and get it all going again.
Exactly. Another stock that I bought, it was Elan. This is going back off of the 1990 bear market low and setting up when we started moving in earnest here in January of 91. You can see that this name with a lot of other healthcare stocks at the time was setting up, and I'll show you right here. You got a pivot point that might have been buyable right here. It was not maybe the best buy point, but it did set up a little base. You had some VCP action, tightened up right here, came out, but this was the bear market actually started right here. The market topped, so this stock actually tried to come out while the market was in a bear market, but the market bottoms right here, and the Dow was down 23% off its highs. So this stock bottomed shortly after, and then again rips up the right side here and then tightens up. And look at that last bit of tightening. Really nice. Just a few days. I bought it coming out right here. Now, you see this is a base that fails, but is now building a larger base, and it resets. So we talked about pivot failures. These are base failures. Going back to the Dick's Sporting Goods, this is a full blown base failure and a reset. And now Elan is also a full blown base failure, not just a pivot failure, but you take out the lows in the base, and usually that takes more time. That's going to take more time to build that right side. You're not going to just repair it in just a few days, or even usually a few weeks. It's going to take some time to repair that. So the larger the break, a base failure is going to take longer to repair and to reset than would a pivot failure. So here's another. Let me just get rid of that. Another thing that you want to be careful with is V-shaped bases. And again, you sometimes can get a V-shaped base and it breaks out. This one came out of a very sloppy right side. It fails, and then you set up a much better base here with a cheat area, and then you get a handle right here. So again, a base reset and a base failure. You get a full-blown base failure, pivot failure first, then base failure, and then you reset. And if you were in this name, or you're watching this name, and then you decide to take it off of your watch list, you would have missed this subsequent setup. Just a few more.
Yeah, I'm going back on that. What's kind of interesting is how once it resets, how it becomes so orderly. It moves up and then it drifts sideways. It moves up, drifts sideways, moves up, and it turns into a totally different stock than what had been happening for the last I guess that's the last 9 months of going sideways.
Yeah, and you get more symmetry too. It's rounded out a lot better. Just a much better looking chart there. Again, I'm going to show you a few that are a little more creative, and that's using the low cheat. I get very creative with the low cheat. This is setting up right here. You started off with a power play coming from a low cheat. It runs up here and pauses as it very well could when it comes back up to the old highs. That's completely normal. But then it comes in all the way down and undercuts the low in the base. So you've got a full-blown base failure here, but then sets up another little cheat area right here. You get another low cheat and then breaks out from there. You don't get much of a right side development subsequent to that. You do get a pullback all the way back down, but you get some tennis ball action. So this is, again, you can get very creative with this, and you can start playing around with it where you're getting these entry points. But here's another one here, Spartan Motors. Incidentally, this is Spartan Motors in 2016. I traded Spartan Motors. It was one of the first names that I traded back, I think, in the mid or early 80s. They used to make fire engine chassis. I think they also make them for RVs. So this is a low cheat, comes out one day and then fails, comes right in here. You get the pivot failure, base failure, but then just a few days later, up, tightens up for a few days, and bang, comes out of there. So you get a pivot reset. And then one last one, again, very creative, coming right out here, coming out of a cheat area, sets up nice tight, real nice tight area here, sets up a good sized base, breaks out, and then again fails. You get a full blown base failure, but then you get the subsequent low cheat. Now again, this might be characteristic of the general market. You might get a bunch of names that are coming out, but then the market rolls over and you get a correction in the market or a bear market. And then as the market bottoms, coming up off the lows, you start getting these low cheats. So you got to put it into context and keep it into perspective. But again, just giving you, showing you how this can play out, and showing you some creative ways to use the low cheat, the classic handle. Basically, virtually every buy that I make is coming off of a cheat, a low cheat, a handle, some type of flat base, and they all have VCP characteristics. I'm not really doing anything more than that. That's pretty much what I've been doing for the last 3 decades. And again, we've covered a lot here. All right. And there's a lot of information to digest here, and you're going to have to do a lot of practicing and look at a lot of these charts. And as Dave said, go back, look at winners, see what they look like, look at your mistakes, mark them up. You have this material to compare to and to see what a stock that's showing you the confirmations looks like, what the stocks that have the violations, what they look like, and then you should also start building your own model book of these winners and losers, and you'll start to really see the contrast between the two. So we're going to take a break, and we've finished this section here, and we're going to take a rest here and give you a chance to digest what we just went over. Dave, any final comments before we wrap it up?
Yeah, I just maybe to emphasize what you said about studying your mistakes, because everybody has weaknesses, and maybe it's not analyzing the base correctly, or setting your stops too close or such. But it's only when you study what you've done in the past is where you're going to really learn. Because we lay this stuff out, but then it's your turn to take it, study it, start trading the markets, but learn from your mistakes. Because once you start correcting your mistakes, then you'll be making more money in the market. And that I can't emphasize that enough.
Yeah, and we can go on and on. Dave and I can look at charts for hours and hours and hours and analyze this stuff. I've got thousands and thousands and thousands of pages of, actually over 20,000 pages of model books that I've built myself of winning stocks, and analyze these things for decades. So we're just giving you the tools to be able to look at this and decipher normal price action from abnormal. But now it's up to you to do the work and really study these things going forward. Okay, so we'll take a break, and then we'll see you when we come back.